Hey everyone, thank you so much for joining our webinar today on property accounting best practices. We are going to talk about where property managers go wrong and how to get it right. And we're so lucky to be joined by Raman, a CPA and founder of RSKPJ Accountants. Raman has been a certified public accountant, CPA, for over 15 years now, working at one of the big 5 accounting firms in the US as a tax manager. And he's actually been working with DoorLoop customers for over 2 years now, helping them with bookkeeping, property accounting, QuickBooks, taxes, compliance, tax planning, you name it, he does it, and much more. So today, Raman is going to be giving us some accounting advice, sharing some best practices, and also the biggest mistakes he sees everyone making to avoid. Now, Raman, first off, just thank you so much for joining us today.
Sure, it's nice to be here, David.
So start us off by telling us a bit about yourself and what you help to teach everyone today.
Sure. So, as mentioned, my name is Ramon, and I've been a CPA for about almost 16 years, and um, it's been a excellent journey because accounting is a very unique field that allows you to help individuals with their businesses and also personally as well. So it's been a wonderful journey. As you mentioned earlier, I worked for one of the big 5 accounting firms in the past, which has allowed me to gain very good experience, very technical experience as well, that can be very useful in the accounting world. And as you also mentioned, I've been working with DoorLoop clients for a while now as well. And I'm very acclimated with the software, so I'm able to know certain ins and outs and also apply the accounting background and skill set that I have to DoorLoop to properly use the software and service the respective clients. So I also have a master's in taxation, so that's one of my specialties as well. Along with obviously being a CPA, we do accounting and bookkeeping and tax advice as well. So all of these services are part of the spectrum that we offer.
Amazing. So there are a lot of people on this call right now that are DoorLoop customers, some that aren't customers yet. So we're going to take them through sort of some of the things that you see every day. And if you want, you're more than happy to share your screen and sort of jump into DoorLoop and show people how they can do this in DoorLoop. And when we were talking offline, the first thing you mentioned, the biggest mistake you're seeing everyone make across the board, no matter what platform you're using, QuickBooks, manual, pen and paper, spreadsheets, bank reconciliation. You said most people either aren't doing it or they're not doing it correctly. So explain.
Yeah. So essentially, even experienced accountants, one of the biggest issues they have is properly doing the bank reconciliations. And normally there are 4 main reasons as to why you won't be able to reconcile your bank account. Before I delve into that, let me tell you the importance of why you should reconcile your bank account. So essentially, reconciling your bank account helps you prevent fraud because all the transactions that went through your account, you're capturing that in your software. So if a certain transaction happened in your account that you were not aware of, by doing the bank reconciliation, you actually become aware of it and you're able to rectify the situation. It also allows your books and records to be very accurate. So that's the reason for a bank reconciliation. So back to my initial point, the 4 main issues I noticed that individuals have as they do bank reconciliations are: number 1, the beginning balance that they entered was not correct. Number 2, the total deposits they entered was not correct. Number 3, the total expenses was not correct. And number 4, the ending balance was not correct. So using DoorLoop as an example, you can see my screen.
Yep.
Let's use an arbitrary bank account here for which we're doing a reconciliation.
And this is the same process when using QuickBooks or any other platform, right?
Exactly. Bookkeeping software, same concept.
Okay.
So you start here, for example. So our beginning balance, you would check that it matches your bank statement's beginning balance. And then you enter your ending balance. We'll use an arbitrary number here.
Yep.
And the date.
And let me ask you, if you are not sure if you're doing the right things here. I mean, obviously, if you use DoorLoop, you could ask us, but at this point, if people are not even feeling comfortable doing this, do you recommend they just hire a bookkeeper to do it for them?
Definitely. But it's such a thing though that once you practice it a few times, even if you had a bookkeeper do it for you initially, if you have the bookkeeper show you how to do it and you get a knack, you can do it going forward. But for the initial stages, yes, I would suggest to get some assistance.
Okay, got it.
So those two checkpoints are good, the beginning balance, the end balance. The other two risk factors are the revenue and expenses. So in DoorLoop or any software, you can always check your total deposits. In this case, it's 952.01. If you look on your bank statement, that's the number you should see for the total cash or deposits coming in. If that matches, that's check number 3. And the last issue is the payments. In this case, it's $5,387.77. So all your funds leaving your accounts, your checks, your withdrawals, your bank fees should sum to this number. And if all those are checked, then you should be able to complete a reconciliation. It's as easy as that. So if ever you're doing a bank rec and you can't reconcile, it has to be one of those 4 things.
Got it. How often should people be doing this?
Monthly. You should do your bank monthly to reduce, and transactions are more fresh in your mind.
What happens if you see that something's off? What are some common causes of bank rec being off?
Sure. One, apart from the 4 risk factors, within those 4 risk factors, another sub factor could be that you use an incorrect date. So if we're doing the bank reconciliation, for example, for the month of January, and you use, instead of putting January 31st, you put February 1st, then the transaction will not show up among the transactions in the bank rec, and it will be missing. And so you'll be off by that exact number. So sometimes you just have to go back and check to make sure that you use the correct dates.
Got it. Okay. I mean, is that it? That simple?
Yes, that's simple if you remember those 4 checkpoints.
Okay.
If you arbitrarily try to figure it out yourself, you could be there for hours.
Okay. Awesome. Okay, great. Let's move on to the second one. So offline, you'll show me the second thing you see is tracking fixed assets. Specifically, you mentioned that you may have expenses booked, but not with depreciation. What do you mean by that?
Sure. So when it comes to entering fixed assets in any bookkeeping software, that's normally when you need some accounting assistance, because you have to make sure that it's done properly and in line with GAAP. GAAP stands for Generally Accepted Accounting Principles. So normally when you're entering a fixed asset, you have to enter the building and the land. What does that mean? If you purchase a property, whatever price you paid for it, that price includes both the physical building and the land on which it sits. So for accounting purposes, you actually have to separate those 2 items when booking your fixed assets, because one is depreciable, which is the building, and one is not depreciable, which is the land.
What if you buy one apartment in a 200 apartment building?
Same concept. Whatever price you pay for the apartment, let's say it's $300,000, you would apportion part of that $300,000 to land. So part would go to building, part would go to land. To know how much to apportion, you could use one of 2 things. You can go to the appraiser's website for the respective states and city in which you live, and they normally tell you how much to apportion to land based on the property taxes you pay on the property. So you can normally figure out the land portion. If you still can't figure it out there, a nice simple rule that accountants use is that 80-20% breakdown when it comes to apportionment. So 80% would go to building and 20% would go to land.
Wow, the Pareto principle in factor everywhere. So why is this important? Because are you saying that people, property managers and owners could be getting tax breaks and they're not taking advantage of it?
Well, it's actually more so the opposite. They would be taking too much depreciation, because if you buy a property for $300,000, and you allocate all of that to building and depreciate that over 27.5 years if it's residential or 39 years if it's commercial, then you're actually taking too much depreciation each year than you are entitled to. Because instead of taking 300,000 worth of depreciation on the property with 300,000 as your base should more so be 80% of that. So you'd be taking too much depreciation, which a risk is an audit risk with the IRS.
Okay, you get audited and you're paying fines and penalties and interest and all that.
Yes.
Okay, got it. Okay, that sounds pretty simple enough. So when you're entering the property in, enter the land value and the building value, normally 80/20, or find it online, and that's it. That's all there is to it.
I could show you a quick journal entry if you wish.
Sure.
And DoorLoop an example.
Yeah, let's do it.
So let's say we're using this property. And another powerful feature of DoorLoop is that you can actually select the property in which you're booking things versus using classes and so on in other software. So that's another advantage which we'll discuss later.
Yep.
Right. So here you put the building portion. If you notice the description says building. Let's say the value of the building is $1 million. You purchased $1 million for the property. And then your description. So if we're using the 80/20 breakdown, which most accountants use, 800,000 goes to building. Land would take 200,000. And then on the other side of your journal entry, so you debit these two amounts and you would credit the loan, because most times when properties are being purchased, there's some kind of loan or mortgage. So let's say the mortgage on this, you took a mortgage out of 900,000, and then you made a 100,000 down payment, either using the business bank account, in which case you'd use the checking account here, or if not, if you use your personal bank account, because it's in the initial stages, you would simply use owner contribution. Most times it's owner contribution because a property was purchased before they started the company. Got it. And that's it. And that's how you book the entry.
That's it. It's easy for you, but I'm sure a lot of people watching are like me, like, okay, not super simple. So how are people supposed to learn this stuff as new property owners and managers?
As mentioned, the same concept as with the bank reconciliation. You'll need the help of a bookkeeper or an accountant in the initial stages. But once you learn the technique, then you can do it yourself going forward. Or if you're more comfortable having the accountant do it indefinitely, that's an option as well.
Okay. So was that showing us also how to book depreciation expenses and year-end adjustment journal entries, or is that something else?
So good question. So the next step is at the end of the year, you have to capture depreciation. And once again, your accountant would show you how to book this. So you simply go to the property and you make a debit to depreciation expense.
Are you doing this on December 31st, January 1st?
So this should normally be done at year end. It's a year end adjusting entry. So normally we select the last day of the current year for which we're booking it. So let's say we're using calendar year 2024. We would update the date to show that. And then you would debit depreciation expense and credit accumulated depreciation.
Got it.
And normally to determine how much depends on the type of property. So I alluded to this earlier. If it's a residential property, which means you're renting it to actual individuals, not businesses, then you depreciate this over 27.5 years. So you simply take the building portion, not the land portion, the building portion, and then divide that by 27.5 to determine how much to enter each year for the next 27.5 years as your depreciation expense.
Okay, got it. I'm sure someone in the chat could throw up a calculator that they find online of this. I'm sure someone has this online. Okay, got it. Okay, Not too bad. Not too bad. I'm still following. So you also mentioned earlier per property accounting. It's my understanding in QuickBooks, did you mention classes? They don't do property accounting?
Right.
Both that?
Well, yeah, in QuickBooks, essentially, for you to designate transactions to certain properties, you have to use classes. And then the classes are limited because you're not able to generate certain reports from them. And it's very, it's a heavy lift, even for accountants. So the benefit of DoorLoop is that as you're booking transactions, instead of using classes, you actually use what you're doing, a property. And so you select your property that you have set up in the system and you book your transaction on that property. The benefit of that is that when you run reports later, as shown here, you're able to see the balances per property. As you see, each column represents a property. So that's one of the benefits of DoorLoop versus other bookkeeping software is that you're able to designate something to a specific property, which helps with your reports.
Okay, got it. And you also mentioned GAAP accounting. I'm familiar with GAAP accounting. I'm assuming many people might not be. So let's touch on it a little bit. And I guess my first question is GAAP accounting to me sounds like something that larger companies look into. But if you only have a few units, 10, 20, should you be doing GAAP accounting? Should you tell accountant you want GAAP accounting? What are the benefits and when should you start looking into GAAP accounting?
So the accountant answer is always use GAAP, obviously.
Okay.
But technically, if you have a smaller property management company, it's just simpler to use the regular accounting methods you would normally use as you book things in the system and generate your reports. But as your company gets bigger, it's better if you use GAAP accounting, which mainly says that, at least for our purposes, just to simplify, because it's a huge section of the accounting profession by itself, but just to simplify for property management purposes, you want to separate your operating income from your non-operating income. And operating income simply means whatever income your business generates from the services you provide. In this case, whatever properties you rent, whatever net income you generate from that should be kept separate from the non-operating income, which are items that are not directly linked to the service that you're provided. So there are two main items based on GAAP. Three, but for property management purposes, just mentioned two because these mostly apply. That should not be part of your operating income. Number one is interest income and expense. And number two are income taxes, not property taxes, because property taxes is part of your operating, but income taxes, taxes you pay to the federal government or your state. Those should not be part of your operating income. So using this report, for example, in DoorLoop as an example.
By the way, what's the benefits of using GAAP accounting?
So good question. The benefit is that you really see how well your business is performing based on your operating income, because those are the driving factors in your company. The non-operating income variables, interest, income and expense, and income taxes fluctuate year over year. So they're not a true reflection if your business is successful or not, which is why they're not part of the operating income.
Interesting. And I'm assuming if you want to sell your portfolio or business one day, GAAP accounting will be much better and easier for them. Okay.
Definitely. So if you notice in this profit and loss statement, we have the operating income amount shown here, and interest income is separate below in the other income section, and income taxes is also separate below in the other expenses section. So this is your operating income, this is your non-operating income, and this is your total net income when factoring in both.
Okay. So it's just more simplistic and more organized.
Yes.
Okay. Any more work to do this? Any more cost? If you ask your accountant today, please switch to GAAP. Is it a big, heavy lift?
No, it's just reclassing certain income and expense items from regular income to the other income and other expenses section. So they show up at the bottom of the report.
Okay. Okay. Got it. I'm seeing some questions in the chat about QuickBooks. Let's talk about QuickBooks again for a second. So there's a lot of people that are using QuickBooks today that are looking to leave QuickBooks and that are looking to keep QuickBooks and use DoorLoop at the same time. So if you are using both, what do you need to do? Just make sure that you have good records in the same systems. What are you doing?
So first of all, you don't need to use both bookkeeping software. It's like trying to drive two cars at the same time. It's impossible or doesn't make sense.
Okay.
So just pick one or the other. If you're involved in property management, whether as an owner or as a property manager, DoorLoop is much more easier to use, more productive, more efficient, generates much better reports. It has portals that you can use for your tenants. It's just better overall. If you're doing anything else, then probably QuickBooks is better.
Okay. So property accounting with a DoorLoop or other PMS software, but then business accounting, credit card expenses, all that, still use QuickBooks?
Yes, that would be my submission in that.
Saying employees use QuickBooks, so everything else use QuickBooks.
Well, employees, you can have employees in your property management company. More so, it's the industry that I'm making reference to. If your industry is real estate or property management, then DoorLoop is much better. If your industry is anything else, you're a lawyer, doctor, contractor, whatever the case is, then QuickBooks probably would be better.
Got it. But if you are a property manager using DoorLoop for your bookkeeping, you can still use and maybe should still use QuickBooks for paying employees and handling your business expenses.
For paying employees, you can do that using ADP actually. So you don't need to use QuickBooks. QuickBooks has a payroll feature, but you have separate payroll companies out there like Gusto, ADP, as I mentioned, which you can still use them and still use DoorLoop because you may have a property management company with employees, right? And you pay them. And you could just simply run it through ADP and then enter your transactions in DoorLoop to show the payments. So you don't use QuickBooks even when you have employees. QuickBooks is more so an industry issue. If you're not doing property management, then use QuickBooks. If you're doing real estate or any property management, use DoorLoop.
Okay, got it. And one quick thing I saw in the chat also, someone asked you have to pay to allow your accountant to use DoorLoop. So no, in DoorLoop and actually most property management softwares, they don't charge per user, they charge per unit. So you can invite as many people or employees as you want. And just like in DoorLoop, you can invite your accountant for free to get access to DoorLoop to run your books, to view access, edit access, delete access, all the different security permissions can be done. And you can invite your bookkeeper and accountant to do it. I'm assuming, Raman, that's what a lot of people do with you. They just invite you to their DoorLoop account as a user? Okay. Okay, got it. Tell me, so far, it seems pretty simple, just learning the basics and then just replicating it. We mentioned before, I think you mentioned this to me about the DoorLoop tutorials or help center. Is that like a good place where people can learn accounting best practices using DoorLoop?
Definitely. In fact, when I was beginning to use the software, that's what I went through thoroughly to be able to navigate the software properly. Because even though I know accounting, we have the temptation at times as accountants to simply just use journal entries for everything, which will allow things to be booked properly, yes. But when you have a powerful tool like DoorLoop, it's best to use the built-in features to book certain things instead of using journal entries. A prime example is when booking rent. If you simply book a journal entry to capture rent that you receive from a tenant, the problem with that is that when you go to the leases in DoorLoop and the ledger for the actual tenant, you won't see the actual rent showing up for that tenant. And so it may show once that tenant logs into their portal, which is another feature DoorLoop offers, a portal for the tenants so they can see their outstanding rent. The rent will still show as outstanding for that tenant, even though they actually paid, which we know would cause a nightmare because they would complain, I just paid the rent. Why is it still showing as outstanding? So it's best to use the built-in features. If you look at my screen here, for example, you have to enter charges to show the rent charge itself or the rent expense. And once you receive payment, use the receive payment feature to capture the rent. So the tutorials It's called DoorLoop University, is very useful for anyone, accountants or not, to learn how to properly use the software.
Okay, awesome. Thank you. And speaking on the same topic, you spoke to me offline about categorizing transactions, specifically when should people use the expense versus the bill feature and payment of the bill. You want to get into that?
Sure. So just by using DoorLoop over the time period in which I've used it, I have noticed that it's cleaner if you simply book your expenses using the expense feature. So if you look at my screen, it's best to book your expenses using this feature, the expense feature, versus the create bill feature. Reason being, when you do the create bill feature, it simply captures the charge, but then you have to remember to record the payment once it's paid. And if you don't, it will throw off your books and your records and your accountant. When you use the expense feature, it does it simultaneously. The same time you enter the charge is the same time the payment is entered as well. So it's cleaner. And most of the times that's the case anyway, because you're booking your transactions retroactively. So you know what date it was paid. So it's much cleaner to use the expense feature. The only time you would need to use the bill feature is if you're booking your transactions every day and you just issued an invoice today and you want to book it today because you're not sure when it will be paid, then you could probably use the bill feature. But if you're booking your transactions 2 days after they happen or a week after or at the end of the month, then you will know what date it was paid and simply use the expense feature.
Got it. Okay, understood. And is that similar with booking rent payments? You mentioned that some people book rent payments into the wrong account, and that's why some tenants, it shows they didn't pay rent. Can you explain that?
That's a huge issue. So most of the clients that come to me from DoorLoop, that's one of the main issues I've noticed. When they're booking the rent payments, they're booking it to the wrong account.
That's only if they're doing it manually, like if they receive a check or cash, not through the online portal payments.
Right. So the online portal will do it correctly, provided you have it maxed properly in DoorLoop to the correct bank account for that property, which most of the time is fine. But yes, it's only when they do it manually. Let's say the tenant paid via check and they're entering it manually in the system themselves. Sometimes I've noticed they use the wrong bank account. And so when they're doing their bank recs, that's another reason why the bank recs are off. The deposits, that's under the deposits category, one of the 4 categories. And that's one of the reasons why it tends to be, they booked it to the wrong bank account instead of using the correct.
Okay. Okay. Got it. Okay. Awesome. So good to know. And let's switch gears to the last half of this, which is tax. Everyone loves taxes, or at least saving money on taxes. So walk us through, and if maybe you could pull up the reports and show us what are the most important reports you need to file taxes and prepare for your taxes every year.
Sure. So to keep this at the simplest level, because accountants who are online, we know it can get a lot more detailed, but most accountants, I would say, would ask for these 4 main reports, which are added as favorites here. Your balance sheet, your profit and loss, your trial balance, and your general ledger. All these 4 reports have sufficient information for your accountant to properly do your taxes based on the reports in DoorLoop. And each of these reports in DoorLoop, the balance sheet is in this section, the business overview, as is the profit and loss.
Got it.
The trial balance is more in the accountant section, along with the general ledger. As shown here.
Explain what is the trial balance?
A trial balance is a consolidation of your balance sheets and your profit and loss. So instead of having 2 separate statements, it combines everything into one big report. So some accountants even prefer to just ask for the trial balance because it combines both the balance sheet and the profit and loss.
Got it. Okay, awesome. And talking about reports, not just for tax purposes, but every day, week or month, what should property owners and managers be looking at? Which reports?
Sure. So for those who are not accountants or for non-tax purposes, the main reports that property managers I've seen would benefit from are the rent roll report, which shows the outstanding rent per tenant. That's a wonderful feature, by the way, that DoorLoop has, which some other bookkeeping software companies don't provide. But it shows a wonderful summary of the outstanding rent for each property and each tenant. So that's number one, the rent roll report. Number two would be the, let me just think, your rent roll report,
Owner statements?
your owner statements. Yes. So the owner statement simply shows the amount that should be paid to the owner each month. So many individuals here are property managers. And so you are the middleman or woman, so to speak. So when the tenant pays rent, you are obviously managing how much expenses need to be paid from that rent. Then you pay yourself a management fee. Then you give the residual to the owner for whatever is left over for their obvious earnings. So a good statement that most owners would ask for from the property managers that summarizes all of this is the owner statement, because it shows you how much rent came in, how much expenses were paid from that rent, how much the property manager paid themselves, and the residual, which is the amount that they, the owner, received.
Got it. Okay. Love that. Love that. And you can just download it, export it, send it to the owners. And you recommend sending it to the owners monthly, quarterly?
Monthly. Everything in accounting should normally be done monthly.
Okay.
At the very least.
Okay. Okay. Got it. Cool. I think there's like one or two last things that we spoke about. One of them was on dates. I think you mentioned like, hey, no matter what you're inputting into the system, make sure the dates are correct. If you're booking a payment or a charge or anything in January, make sure the date's in January. Can you talk about that for a second?
Definitely. So that's actually, as mentioned, one of the bigger mistakes that I see. There's this one client from DoorLoop, for example, that every time he reaches out to me for assistance, I would say 80% of the time it's a dates issue. His accountant is good. He books everything properly, but he just uses the wrong dates. And what happens is, the reason for this is when you enter a new transaction in DoorLoop, it arbitrarily, if you notice here, uses today's dates. Now, you just have to be cognizant that if you're booking something from last week or last month, to change the date. So sometimes property managers or accountants or bookkeepers are in such a rush to book the transaction that they go here and they enter it and save without changing the date. So the date is so simple, but so important.
Got it. Okay, awesome. And lastly, you also talked about when booking recurring rent charges, it takes some time to book and it might create duplicates if you do it again. So when you're booking a recurring rent charge, just do it once, right?
Exactly. So DoorLoop has this unique feature as well, which other bookkeeping companies that I've seen don't have, wherein that's not property management related, wherein you're able to actually book recurring charges for your tenants in advance. That way, each month you don't have to manually do this. But with DoorLoop, I've noticed just give it a day or two for the system to go through the background IT channels for it to show up in the reports. Because if you go ahead and book another charge prematurely, you'll notice that they're duplicates. So just a tip as you use the recurrent charge feature in DoorLoop, just be very careful to not be impatient and book another charge prematurely. Just simply wait for the system to update and then you can go from there.
Awesome. Okay, great. Okay, awesome. We're going to open it up for questions. There's a lot of people asking questions. So in about a minute, we'll get to it. But before we do, any final words or advice or tax advice or strategies or anything like that that we want to share?
I think we summarize it pretty well throughout our entire conversation. The main things in accounting is discipline. So make sure that you're just doing things monthly, keeping up to date, because oftentimes if you let things run until 2 or 3 months down the line, you may not remember what certain transactions are for, and you're more likely to have mistakes. A second thing I would advise on is when you're setting up DoorLoop for the first time, it's best to use an accountant just to teach you the different steps and the different entries, just like we did with the fixed assets or with depreciation, just so you learn how to do it properly. And then once you're comfortable doing that, if you want, you can then do it yourself going forward. Or if you want to retain the accountant, you can simply retain them going forward as well. The some of my main clients from DoorLoop have been the ones who have prematurely done everything themselves, thinking that it's being done properly, and then they send me their books saying I can't figure out why my books are off, and it actually costs them twice as much because I have to undo what they did and then do it properly. So it's a wise move that in the initial stages, use a professional just to help you set it up. Use DoorLoop as well. They have a great team that's very responsive. Use them for certain non-accountant things to help you know how to use the software, set up certain things. And if you want accountant help, reach out to an accountant who knows DoorLoop that can help you set it up properly. And once you get the hang of it, then you can do it yourself or keep using the accountant. It's up to you.
Yeah. And we're going to throw it in the chat. We have a help center with tutorials, FAQs, screenshots, videos of how to do all this. We have a DoorLoop University where you can learn all this. Also, we offer free training and onboarding. So a lot of people don't take advantage of it, and then they go in thinking they can do it all, and they break things sometimes. So always take advantage of the free training that's available to you in any platform. So Raman, talking about your practice specifically, does your accounting firm only handle Florida clients or people anywhere in the U.S.?
Anywhere in the U.S. So CPAs, once you're licensed in a state, you are able to practice anywhere in the U.S. Unless you're doing audit in, which is not the case here. So we service clients all over the U.S., regardless of the state or time zone. That's not a problem. And so bookkeeping is actually our secondary function. Our main function is actually tax compliance. We're tax accountants. So we mainly do tax returns for both businesses, individuals, international tax compliance as well. But bookkeeping is also a huge part of our practice, as mentioned, where we service clients when it comes to QuickBooks and definitely the DoorLoop.
Got it. And you mentioned some people, I'd say DoorLoop customers, that need extra help above and beyond. They already have their own accountant, but sometimes they also work with you just for DoorLoop related issues. Is that what it is?
Correct. So many times their accountants, some of them have been using the same tax person for many years. And so they're comfortable with that person. So they stay with that person, but they simply come to me for help with bookkeeping from a DoorLoop perspective. And sometimes some of those clients come over to, and have them do their taxes going forward as well, just to keep everything in one place, have the same person do both. But I have both set of clients.
Okay, awesome. And we'll throw in the chat your website, but what's the best way someone can reach you if they had questions for you?
Through the websites. On the website, you have a chat feature and an info request feature. So either of those will work perfectly fine.
Okay, and it's rskpjas.com, and we'll throw it in the chat now also. Okay, awesome. Okay, Raman, thank you. That was amazing. We are going to open it up right now for a live Q&A where everyone can just start asking you questions. There's already a few that I'm going to go through. Most importantly, on the bottom of the chat, there's a chat and there's a questions tab. Please click the questions tab and submit your questions there so we can answer them live on the screen or reply back. It just keeps things really organized. Raman, first, I'm going to make you larger on the screen. So stop sharing your screen. I'll make you larger 1 second. Oops, sorry about that. I clicked the wrong button here. So Raman, okay, you're back on. Perfect. Alrighty, so we're going to open it up for questions again. So everyone, before we do, I am going to share a survey right now. So far about the webinar, if you could take our survey and let us know how we can improve for future webinars. So once again, Raman, I'm going to start bringing up some questions that people are asking. So a lot of them are asking DoorLoop questions. We're going to cover more accounting questions here for Raman, but our team will keep answering those DoorLoop questions. So let's see. Let me find a good one for you. We'll go with this one up here. Well, Raman, someone's asking for your details. We'll share it there. Kevin, there will be a copy of the webinar afterwards. You're going to get an automated email, so don't worry right after. Cool. All right. Sorry, we're going to share the details after. Just going through all these. So, Raman, I don't know if you know this question. Can you lock a previous month in DoorLoop?
So I know that QuickBooks has that feature. You can lock a previous year. And as it pertains to a month, that would not be a good accounting move. You only lock the year, not the month. Reason being, oftentimes you have to go back and make changes. Primarily at the end of the year when it's time to file your taxes. Your accountant may say, can you recategorize this transaction from this month or from that month? So if you log the month, it makes it that much harder to do that. Accounting best practices say that you lock the year, because when you log the year, you then roll forward your retained earnings to the following year and track that on your balance sheet going forward. So as it pertains to if DoorLoop can actually lock a month, that would more so be a DoorLoop IT question. But from a best practice point of view, from an accountant point of view, normally I don't think it's a good idea to lock the month. Perhaps a good question would be why they're asking that question. Then perhaps I can give you a workaround to accomplish your ultimate goal.
Awesome. All right. Thank you. Next one comes from Corey. How do you input and keep track of an active petty cash account?
So petty cash is synonymous to a bank account. So the same way that you set up your business bank account is the same way that you set up your petty cash account. As to keeping track of the balance, it's pretty much impossible because there's no bank statement each month to reconcile. So it's pretty arbitrary. So whatever you put in petty cash is what will be there. So, and it's, as the name suggests, it should be a very miscellaneous amount. You shouldn't have a huge lump sum in petty cash. Only $1,000 the most, depending on the size of your company, obviously, but that's a good barometer. So you shouldn't and don't really need to keep track of petty cash because it's a very low risk there. If you lose it, it's only $1,000. What you need to keep track of are your main accounts, your checking accounts, your savings accounts, and do your monthly bank reconciliations.
Awesome. Thank you. Next one comes from Michelle. For a company that's recording both the PM company books and owner books, is it best to track all items in the balance sheet versus duplicating all the transactions?
Okay. So that's a good question. So, and I saw this in the chat earlier as well. You can do both your property management books and your owner's books, the clients that you're servicing, in DoorLoop. The only difference is that for your company, you would create a new property, a separate property, call the name of your company, whatever the name is, and any transactions linked to your company, you would book it under that property. And then all the other transactions which are linked to the owner, you obviously book it under the respective address, the properties for those owners. So the good thing about that is that when you run your reports in DoorLoop, you can filter which property you're running your report by. And that way you can simply enter your property to see your financials separate from the owners. Also, hopefully that addressed your question. But I think they also asked something about running something simultaneously. Can you repeat the second part of the question?
Oh, I think I may have lost it already, but well, I'll try to find it and get back to it. I am seeing a lot of people that I'm going to throw up another poll here asking questions about DoorLoop that are not customers yet. So you should see a poll popping up on your screen soon. All right. Next question. I'll try to find the second part. So how do you lock the year in DoorLoop? Okay, I guess it's a follow-up question.
I guess my question is what's the intent behind locking the year? I'm trying to figure out why individuals are trying to do this. The system automatically rolls forward the transactions to retain earnings, which is accounting best practices. And you don't really need to lock the year because many times you have to go back and make changes. If you have to amend a tax return, for example, you have to go back and make changes to your books. If 2 years later you change accountants and they find mistakes that were made 2 years ago, you have to go back and change your books. So when you say lock in the year, I'm not sure if I'm understanding the question they're asking in that regard. I think the better point is that whatever net income you have for that year automatically rolls forward to retain earnings. If that's your question. and that's accounting best practices for your net income for the year to roll forward to the following year. And every accounting software, DoorLoop, QuickBooks, they all do this. So if that's your question, then you don't have to worry about locking the year. The system automatically does that.
Awesome. Great. So I found the question from Michelle. The second half of the question was, is it best to track all items on the balance sheet versus duplicating all the transactions?
I'm not sure if I understand that question.
Okay.
Essentially,
No ways to clarify.
I'll try my best to interpret what the individual is asking Michelle. The balance sheet and the profit and loss are simply outputs. So your main focus should be your inputs, doing your bank recs, entering your transactions. When it's time to run reports, you can run a plethora of reports: your balance sheet, your profit and loss, your owner statement, your rent roll. Those are all outputs based on your inputs. So your concern shouldn't really be with the balance sheet. Once you do your inputs correctly, you'll be able to run all the reports you need and even manipulate those reports as well by property, by year, etc.
Awesome. All right. Odette has a great question. Can you catch up your accounts and input backdated information to start using the reports now?
Yes. So I'm guessing you're transitioning over from another software. So that's as we alluded to earlier, that's a very important step. Whenever you're transitioning from another software to DoorLoop, you need to bring over your beginning balances as of a certain date. Let's say you transition May 31st. You need to have all your financials, your profit and loss and balance sheet primarily in your previous software, run reports for those up until May 31st, and then have an accountant help to enter the beginning balances in DoorLoop as of June 1st. That way it's fluid. You're continuing tracking your net income and your balance sheet items, etc. But I suggest to use an accountant to do that journal entry, because if you do it wrong at the end of the year, when you run your reports and submit to your accountant who's doing your taxes, it will be off. It won't be correct. And that puts you at risk for an audit. If audited and the IRS looks at your books, they'll clearly see that you're not tracking things properly. So that transitional phase is very technical and very important. And I suggest you use an accountant for that. And once they do that, then you can do everything else by yourself if you wish.
Great. Awesome. I'm not sure I understand this next question. Please advise how to book vendor advance. Do you understand it?
Vendor advance, like as if the vendor pays in advance.
Let's go with that.
You pay a vendor, the vendor doesn't pay you. If a customer or a tenant pays in advance, not a vendor. I'm not sure.
Maybe clarify.
Yeah.
So you can submit another question and re-clarify. Next one is from Matthew. What is the charge to have a DoorLoop accountant, let's say yourself, Raman, to help me get this set up properly?
Sure. So our standard billing rate is $100 per hour, and it's fair because whatever time it takes is whatever we bill. And just to give you an idea, to do a monthly bank rec, let's say if it has about 30 transactions, it normally takes us about an hour and a half to, if we're fully booked and everything, to build the transactions, to do the reconciliation, to make sure everything is correct, and so on and so forth. So for every 30 transactions, it takes about an hour and a half. So if you do the math, that will cost you about $150 for a month's worth of work if you have roughly about 30 transactions.
Got it. Okay, awesome. Thank you. Next one. This is a good question from Jacob. You can see it on your screen, right? If I'm managing a portfolio of properties for different owners, is the income on my QuickBooks just the management fees, late fees, court fees that I earned from managing the property? Or do I record the gross income from the properties as income and expense the owner distributions as owner payment expense? Good question.
Okay. So it's a lot going on in that question. Firstly, I noticed they're using two software platforms, which is fine. Some people still prefer to use QuickBooks for their own property management company. If you're comfortable with that, that's fine. As we mentioned earlier, DoorLoop offers that feature as well, where you can use DoorLoop for your own property management company. So either way is fine. So to answer your question in regards to if you get paid from your owner, whatever management fee income, that would be a management fee expense for the owner and their portfolio of properties. And that would be management fee income for you in QuickBooks. And the owner distributions that are made to the owner would be that's not an income item, it's a balance sheet item. So that would be a balance sheet item for the owner's reports, and that has zero effect on your property management company's books that you're keeping, because that is an owner distribution which only affects the owner's properties. If you pay the owner distribution from your company's funds to the owner, first of all, that normally shows that there's a mistake in your process, because the funds should not be coming into your property management bank account. When the tenants pay, they should be going into the owner's bank accounts. They should have their separate bank accounts. And from those accounts is where the distributions would be paid. So if you have a system where you're paying distributions to the owners from your bank account, it means you're not properly set up. The tenant should not be paying rent to your property management bank account. So you need to adjust your setup first, and then obviously have the tenants pay to the owner's bank accounts, and then from there, the owners take distributions.
Great. Awesome. Adam has a good question. How should I structure two entities that have multiple properties each into another pass-through entity in order to strategize the best method for taxation purposes? Nice.
I see. So you're talking essentially about a holding company here in disregard of entities. That gets very technical. And in general, you need separate accounting advice for this. You don't need to set up that many entities, to be quite honest. Individuals do this sometimes to try to mitigate tax or reduce their tax liability. That actually has the opposite effect, because you're paying an accountant to prepare more returns. Now we have to prepare one return for the holding company, one for the other entities, and so on. So that actually, from a financial perspective, you end up spending more money. Oftentimes, all you need is one main company. And if you're a property manager, for example, you have your own company, your LLC, that you use to manage your different portfolios with your different owners, and that should suffice. You don't need to create subsidiary companies or child companies in an attempt to mitigate tax, because you're not. You're going to pay the same tax. It's going to roll up to the same place anyway. And all you're doing is spending more money to have an accountant prepare more tax returns for different entities. So that's a separate question. I would have to speak to the person one-on-one to determine what they're trying to accomplish, and then I can give the best advice on how to get there.
Okay, awesome. Also, a few people have asked in the questions tab if DoorLoop has like a list of accountants that we work with that are certified in DoorLoop. We don't, but it's a good idea. We should. For now, the only certified accountant that uses DoorLoop is Raman here, which is why we invited him. He's got numerous DoorLoop clients that he helps with taxation. So feel free to reach out, and we threw his contact info in the chat. I'm also going to launch another poll here. So if you're on the screen on the bottom right, click on polls, and you should see that poll. All right. Let's see next. Anything else you want to add so far?
Just as a reminder to be disciplined. Quite frankly, that's accounting in general, just discipline. So follow the procedures, go through DoorLoop University, invest the time to get to 100%, because that's when it shows when you're done. In DoorLoop University, go through all the classes and that curriculum. And then if you have a question on how to do something in DoorLoop, the chat feature is amazing. Or if you Google something, for example, whatever your question is, and here's a trick for when you're doing research, whatever your question is, then you put a colon and then put DoorLoop. What that tells Google is answer my question here, but filter all my results to information from this company's website, DoorLoop. That way, the top 10 results will be articles from DoorLoop and how to address whatever question you have. And just follow those to the T. Don't try and figure things out. Don't use logic, your own logic, because there are rules to accounting, there are rules to the software. And if you are disciplined and follow them, you won't need an accountant. You won't need help from anyone. It will be straightforward for the most part. Obviously, for the more technical things, yes, you may need an accountant, but I'm just saying for the basic day-to-day transactions, doing your reconciliations, booking transactions, if you're careful and follow the videos, you can do it yourself.
Yep. Awesome. So Ram, there's another question up on your screen. Do you create individual sub-level accounts on the balance sheet for each property? Or do you kind of a batch clearing account and then use the DoorLoop reports each month to create a journal entry to move management fees and late fees over to the P&L?
Can you repeat that question? It's a bit long-winded.
Yeah. Do you see it on your screen? You should be able to see it.
Some me not see it.
Hiding.
Yeah. If you could repeat that one, because I'm not sure what order you're going in as well.
Okay. Yeah. So do you create individual sub-level accounts on the balance sheet for each property?
Okay. I see their point. So, that's a good question. Yes, you have to. Reason being, if you use the same name in DoorLoop, let's say, building, and you use that over and over again, it won't allow you to use the same exact name. So you have to put some kind of distinct name and convention to differentiate one building from another. And that's the only reason for that, because otherwise, yes, you could just have one account that says building, equipment, etc. And when you're booking your transaction, once you link it to a property, when you run your reports, the reports will automatically show what property the building is linked to. So I would say, so the answer is twofold. If you know what you're doing and you're very careful, yes, you can only have one account for building, one account for equipment, one account for any other fixed assets. But then you just have to be very careful when you're booking the transactions to select the correct property to which you want the transaction to be booked. Alternative, that's approach number one. Approach number two is you delineate each fixed asset. You put building, then you put the address, and building, and the address for the other building, and so on and so forth. And then, obviously, when you're booking the transactions, you select the corresponding building that's named there with a corresponding property. That makes it a bit easier just to be consistent on how you book things. And also, when you run your reports and give to your accountant, whoever is doing your accounting, either method would be fine, but it's more clean when you have the fixed assets listed with the actual name of the property beside it. But either method could work. The first method requires more skill, and you have to know how to run your reports. The second method requires less skill, and your accountant at the end of the year will get the info they need for your taxes.
Got it. Okay, awesome. Next question comes from Priscilla. What is the best report to track a portfolio of 110 units?
So repeat the first part. What is the best
report to track a portfolio of 110 units?
Well, it depends on what are you trying to see from the report. Are you trying to see the net income? Then it will be the profit and loss. And I suggest to use the report that says profit and loss by property. That way you see how each property is performing, because you have those two separate reports in DoorLoop, one in general and one by property, which is another beautiful feature in DoorLoop. If you're trying to see the net worth of the entire company, then you run the balance sheet. And the equity section of the balance sheet shows a net worth of all the properties. Once again, run that by property instead of just running it consolidated. If you're trying to see how much rent is owed by the tenants, then you run the rent roll report for all those 110 properties, and all the outstanding rent will be showed on that rent roll report. So it all depends on what you're trying to accomplish. DoorLoop has a plethora of reports, and it doesn't matter how many properties you have. All that matters is that you enter the input correctly, build the transactions correctly, do your monthly bank recs. Once the input is correct and neat and organized, you can run a plethora of reports for whatever you need for as many properties as you want.
Awesome. Okay, great. Let's see. Next one. Can you remove a transaction that doesn't appear in your bank statements but is in DoorLoop? And how do you do it?
Yes. So you would exclude that transaction when you link, I'm assuming you have your bank account linked to DoorLoop. If that is the case, then DoorLoop is pulling in transactions directly from your bank into DoorLoop itself. And which also makes me wonder why it would show up. If that's the feature you have, it would not show up if it's not on your bank statement. So it means that arbitrarily at some point, someone on your team may have entered that transaction, which is fine. To simply remove it, you have two options. You can delete it, or if it's pulling in from the feed, which I doubt because it would be on their bank statement if that's the case. But if it doesn't, nonetheless, you can select exclude. There's an option in DoorLoop to exclude a transaction so it doesn't show up in DoorLoop anymore, and therefore doesn't show up on your monthly bank reconciliation.
Great. Awesome. Thank you. Next one from Matthew. Can I pay myself as the owner a set amount as a property manager for tracking all of this for tax purposes?
Okay, good question.
And if so, how much is reasonable?
I see. Okay. That's a very technical question because the IRS has a rule that says substance over form, right? So what that simply means is sometimes individuals go through these steps in order to get a deduction, and that's the form, but the substance is it's the same person. You're the owner, right? So it's as if you're taking an owner distribution. That's what the IRS would say. Let's forget about what you did. You pay yourself a salary or whatever the case is. The substance is, and this is getting very technical, and this is a much bigger discussion, but to simplify the question, I see what they're trying to do. They're trying to get deductions as if they had a property manager in their pay. And the IRS would say, despite the form of you doing that, the substance is you're the same person. You're the property manager and the owner. So that's a distribution. When you take money from the company as an owner, that's normally a distribution. However, what you can do is pay yourself a salary, run it through payroll, Gusto, ADP. You can pay yourself a salary, which is fine because anyone who owns their own company can always pay themselves a salary through payroll. But that will not give you a tax benefit because even though the company gets a deduction for paying you a salary, you then simultaneously have to report the income on your tax return anyway. So they net to zero. There's no tax benefit. And all you've done is paid extra money to ADP to run payroll each month. So you actually lost from a financial perspective by doing that. So to succinctly answer the question, no, it would have made sense to try and get a deduction for that because whatever deduction you get to pay yourself will be offset by the income you then have to report from the money you received for that service.
Awesome. Cool. Next one comes from Constance. Should there be any sales tax on management income?
So it depends on the state you're in. Most states only charge sales tax on tangible items. So if you provide a service, you normally should not charge sales tax, but it depends on your state. New York, for example, is one of the few states where certain services are allowed to charge sales tax. But in general, generally speaking, most states do not allow you to charge sales tax on services. And sales tax is something that would increase your revenue. If you're charging sales tax, you have to give that money to the government at some point. Otherwise, that's stealing, and that's actually tax evasion from a state level, which you never want to delve into those waters. It's bad at the federal, but it's also bad at the state. So if you're trying to charge sales tax to increase your revenue, the logic behind that is flawed because whatever extra revenue you get is not your money. you have to give it back to the state.
Yep, got it.
And also,
Part of the question.
states don't charge sales tax for services.
Second part of the question, when would a property manager ever use sales tax besides that first point?
The vendors are paying, certain vendors may charge you sales tax, and whatever they charge you is what you have to pay. So, and then your expense that you book on your books will just simply be, if it's a repair, for example, you book the repair expense for the full amount. You would not need to delineate that between repairs and sales tax. You simply book it for the full amount that you paid. Sales tax only needs to be booked if you're receiving sales tax, which once again would normally not apply to these services.
Got it. Awesome. Raman, we have maybe like 80 questions. So I apologize in advance, everyone. We're not gonna be able to get to all of them, but we'll do our best. So here's the next one. Corey, for the end of the month reports as a property manager, I struggle with the reports and finding the amounts. Is there a way to pull a report for just deposits, application fees, etc.?
Sure. So,
And is there an actual report for each itemized line item?
well, what you can do is run a transaction report and then export that to Excel and then filter the column based on certain criteria you're looking for. But if there is a specific report for that in DoorLoop, maybe David and his team are better able to answer that. There are tons of reports. There are over, my count, at least 50 reports in DoorLoop. I don't have them all memorized. I mainly use about 20 or 25 of them, right? So there may be one out there that does that, not that I'm aware of, but there's always a workaround. You can always export to Excel from a main report and then filter certain columns for the info that you need.
Okay, awesome. So let's see, next one. Okay. All right. This one's from Anil. Can the income from management fees go into the same operating account, or is it recommended to have a separate account for the property management business entity?
Yes. So, as alluded to earlier, your property management company, the only money that go into that account is when you get paid by the owner. That's it. Every other monies you receive from the tenants should go into the owner's bank account. They need to set up their own account to track the rent for their tenants. It's their tenants. They should have their own account. And if they haven't done so already, they should set it up as soon as possible so the tenants can pay to that account. And the only time monies come into your account, as mentioned, is after the owner gets the rent, he pays the expenses, he takes his distribution, and then he pays you to manage his property. That's when the money comes into your bank account.
Got it. Okay, awesome. So next question comes from, I'm probably going to mispronounce this, I apologize, Bahia. And it's, how do you edit recurring charges with no end date? I realized I couldn't increase a tenant's rent schedule without creating duplicate charges. And you can't delete it because it has transactions associated to it. So can you edit recurring charges with no end date?
So that's a IT question as well for DoorLoop.
Okay.
Know that when you create recurring charges, as I mentioned earlier as well, you have to be careful. Give it about a day for the system to get caught up, to vest, so to speak, because the IT team in the background has to run certain processes to apply these to the leases. So what I've seen happen many times is that someone checks back in a few hours and they don't see their recurrent rent charge and they manually book another charge. And that what will happen the next day is that that tenant for which you did that will have two charges, the recurring one and the one that you booked. So just give it a day or so for the system to set in. As to the actual end date for recurring charge, as mentioned, that's more so a DoorLoop IT question. I'm guessing it should match the lease end date unless the lease is indefinite. But once again, I'm sure DoorLoop IT personnel could address that question.
Awesome. Yeah, there's a lot of questions here for us. So if you have a DoorLoop related specific technical question, for example, please log into your DoorLoop account click the blue chat bubble on the bottom right of your screen, and you could ask us as many questions as you want. So next one is from Paula. How would you categorize for supplies and the labor for a tenant turnover? Is it general supplies, maintenance, and are they treated differently from a tax point of view?
I see. So I'm guessing the tenant is leaving the premises and you have to pay for whatever services
Yep.
for someone to fix the property, what the case is. Uh, That's a regular expense. It's a regular expense. It depends on what it's for. If it's a plumber to repair a pipe, you simply book it to plumbing expense. You have an account called plumbing, or a more general account. I like to have things very neat and organized. So I would have a repair account, and then I would have sub accounts for the kind of repair, whether it's plumbing, whether it's electrical, and whatever the case is. So whatever account you use, though, it has to make sense. So if it's a repair, I wouldn't use supplies, right? It just has to, and that helps your tax accountant at your end when doing their taxes to put the expenses in the correct category on the tax return.
Got it. Okay. Thank you. Okay. This is a good one. Stephanie said, I think it would be great to explain trust accounts versus a separate account for the business.
Exactly. That's what I alluded to. That I didn't want to use technical terminology, but the trust accounts are the ones for the owner, and the any other account, the one for your personal property management company, is simply your property management company account. So they're called trust accounts because the owner trusts that you will turn the funds over to them eventually, much like a sales tax account from a state perspective. When you collect sales tax, you should ideally put that in a trust account as well because it's not your money. You have to eventually give it to the state. So the same thing, the trust accounts for owners should be set up by the owners. So when the rent comes in, the owner trusts that you'll collect the rent and eventually give the monies, the residual monies, to them, the owner.
Okay. Okay. Awesome. That's great. All right. Let's see the next one. Okay. Eduardo said, if you're collecting payments for cost recoveries, for example, CAM charges from tenants, should they be booked as income or as a refund against those expenses?
Beautiful question. I see that the questions are getting more and more technical. So CAM is a very interesting reporting from a property accounting perspective. So to answer that, you would have to book the CAM payment that the tenant pays as income. So in your revenue section on your profit and loss, you would have rent, and then you would have CAM for whatever it is, CAM utilities, CAM property tax, whatever it is. But those will be revenue items that you book when the tenant pays it to you. And then when you then pay those expenses to the respective utility company or the respective state for property taxes, that would be a CAM expense on your expense. So it's an in and an out. So the net effect normally is zero on your overall income, but that's the proper accountant for that.
Great. Okay, great. Next question comes from John. Do you need to record capital expenses like a new roof differently than you would record other property expenses like regular repairs?
Good. Another question. That's also a tax question. For tax purposes, if you're making major renovations and major adjustments to the property, you have to book those as fixed assets or capital expenditures for which they're depreciated over a certain useful life. If it's equipment, it could be 5 years. If it's furniture, it could be 7 years. So if it's a major renovation to the property, that would be the same useful life as the type of property that it is. If it's a residential property and you change the roof, for example, then you would use the same useful life of 27.5 years for residential. If it's a commercial property and you change the roof, you would use the same useful life for a commercial property, which is 39 years. So it all depends on the major renovation you're making. So there's a publication from the IRS that discusses it. It's in the 500 number. But if you go online and Google fixed assets publication IRS, you'll see the actual publication. And it tells you when you would record something as a capital expenditure, a fixed asset, versus a repair. A repair, though, is normally something temporary, not a major permanent fix. A roof is permanent. A door is permanent. A window is permanent. Something temporary would be the faucet. If the faucet is leaking and the repair guy comes and fixes that, that's temporary because it may happen very soon again. Normally, when you fix a roof, you have to wait a long time before you fix it again. When you fix the window, you have to wait a long time. When you fix the floor, when you change the floor, you have to wait a long time before you fix it again. When you fix the plumbing, you may have to fix it 2 years from now. When you fix the refrigerator, you may have to fix it a year from now. So temporary items that have to be repaired frequently tend to be, you can expense those right away as a deduction right away. Items that take a long time before you have to fix them again, that's an easy way to separate them. Like the roof, the windows, the floors, those are fixed assets that have to be depreciated based on the useful life of the property, whether 27.5 if residential or 39 years if commercial.
Awesome. You got a lot of thumbs up on that answer. So next one is coming from Suri. My accountant wants to be able to see reports versus the prior year, and it would show the amount and percentage difference. How can I do that? I'm not sure if we can. I have an idea, but...
Yeah. So if DoorLoop does not already have this report, they should have a year-over-year report showing the variance between years. And I'm sure that's something, if it's not already there, that the DoorLoop IT team can easily add that shows a variance between years from a profit and loss perspective, from a balance sheet perspective, etc. So that's more so an IT question, which could easily be fixed by just adding a new report.
Yep. And feel free to contact us. If we don't have it, we can help you generate it for this one purpose. Yeah, that's fine. All right. Next one from Eduardo. How do you recommend property managers book capital expenditures such as a new appliance or items that might be CapEx, since sometimes it's subjective? Do you recommend they book them as ordinary expenses and advise owners to consult their CPA about whether to capitalize?
Good question. So I would say we gave you some form of education today regarding that topic. And I would say try and use that rule that I gave you. It's best to try and do the best you can from a logic perspective in the moment. And then if the owner's CPA at year end needs to get more technical, then they can. But based on what we discussed earlier, if it's a major fix, just think about how long it will take if you have to fix this item again. If you probably have to wait another 20 years or 15 years, I would more so put it as a fixed asset. If it's something that you probably will have to fix within the next 5 years, I would probably put it as a regular expense.
Awesome. Okay. And just to clarify, I saw 2 questions in the chat saying, does Raman recommend any CPAs that could help us with DoorLoop? So Raman is a CPA, and he can help you personally with DoorLoop.
Right. So we have thousands of people online. So our practice, we would have to increase our human resources if everyone signed up with me. So I'm not aware of any at this moment. It's just a matter of investing the time. Not too many firms want to invest the time to learn a new software like DoorLoop, and it's very robust. There's so many features to it. So our firm has invested the time. Perhaps you can go online and Google to see if there are other CPAs that know DoorLoop. Off the top of my head, I honestly don't know any. And like I mentioned, I can't take all the clients. It's like 1,000 people here. We would have to hire at least 5 new people if everyone came over. So I would love to have another CPA help, but that other CPA firm has to be willing to invest the time to learn the software properly. And
where if you are interested, just reach out to Raman on his website, and maybe he has some availability. So next question, we got 10 minutes left. From Daniel, how would you account the owner collecting personally in cash Does that still go to our books since we are remittance rents to the owner?
Can you repeat that question?
Yeah, and I'll shoot it over to you here also. How would you account for the owner collecting personally in cash? Does that still go to our books since we are remittance rents to the owner? I could ask for a follow-up.
Oh, I see. I think what they're saying is the tenant is paying rent to the owner's personal bank account. I think that's what they're saying. That is a poor accounting structure. And if he or she is audited, will be a nightmare because you have to have trust accounts, as mentioned, if you're using a property manager. If the owner is doing everything, then they still have to have a bank account separate from their personal account to collect the income from the tenants, the rent, etc. And then for tax purposes as well, when you're filing your taxes, you're still supposed to, along the same lines, have a separate bank account showing all your income and expenses. Because if you're audited, that's what the IRS would look at to make sure that you properly claim your income and expenses. When you commingle funds, that's a terminology, the technical terminology, then it's called piercing the corporate veil. And what that essentially means is that if you're audited by the IRS, they will treat every income that they see in your personal account as linked to the business, even when it's not. And so you'll be in a very unfair position in paying a lot more taxes than you need to pay. So that's why it's always important to separate the accounts.
Awesome. Okay, great. All right, next one is from Kevin. This is a good one. I've noticed more property managers charging a technology fee on top of their management fees, like for using DoorLoop as an example. Are you seeing this trend, and what do you typically see being charged?
That's a subjective question. That's based on the property manager. Um, they're free to charge whatever they want. They're the ones providing the service. So if they have to pay a subscription to DoorLoop to use the software to manage the properties for these owners, then logically, I would suggest, yes, you should expense that, charge, an expense to the owner for that, in which they pay you to make you whole for the extra expense you have in purchasing this property management software. Some owners, some property managers rather, simply build that into their monthly income structure. So they normally charge $500 per month, for example, for each property. They'll charge $515 to build in that technology, the DoorLoop subscription fee.
Got it. And second part to the question, would this be considered a management fee or an expense to the owner or tenants?
So it's an in and out. So the owner, the property manager rather, when they receive payment from the owner for their management fee services that they gave to the owner, the amount that the owner pays to them would in total be income, which includes the technology fee. And then each month when the property manager has to resubscribe to DoorLoop to keep their subscription going, that's a software expense for the management company. So the net effect, as you see, is really zero. They got the income in from the owner, the extra income, but it's also an extra expense because each month they have to pay that back to DoorLoop to keep the subscription going. So it's an in now. The net effect is zero on your profit and loss.
Got it. Okay, awesome. All right, next question comes from Jacob. What is your recommendation on how to handle evicted tenants who have an outstanding balance and are in collections? What's the best way to zero this account out so it doesn't show up on the outstanding balance report, even though they're inactive tenants?
I see. So you would simply, do you plan to, if it's in collections, then I guess it's zeroed out from a year perspective, but it's still a liability. So how would you track that liability? That's my only question. How would you eventually still know that this person owes? I'm guessing the owner will.
Well, they also said we'll probably never receive the money. So
Okay. Yeah. So it's two different variables. So if you'll never receive the money, that would be a bad debt expense. And so you would make a charge in DoorLoop called bad debt expense. You would then you would post that charge on your lease, and then you would create a credit on the lease to offset that bad debt. So that's how you would account for that. It's very technical. I'd have to see it in more detail. That's a separate question for which you need an accountant to help, but I could help you with that offline. I don't think we could hear you, David. You're muted.
Oh, sorry about that. In some California cities, such as San Francisco, for tenants who have resided more than a year, after they vacate, they are entitled to an interest on their security deposit, which is set by the cities. I didn't know that. Can this interest be paid out as an expense from the landlord, since the landlord holds all the security deposits?
Good question. So the point that it has to be paid somewhere or another if it's a law, right? So the security deposit, normally that's not supposed to be touched. And this is more so property managers should know more about this than I do. But each state has their laws regarding security deposits. That is not supposed to be touched. Ideally, what many property managers do is they put, if they're following proper property management techniques, they put the security deposits in an investment account where it earns interest, whatever the case is, so that by the time the tenant moves out, you pay whatever security deposits they gave to you over to them, and whatever interest as well. There are actually rules in certain states, like California, for example, where you have to add the interest. So if you're doing proper property management, you should invest those security deposits into a CD, whatever the case is, so that you can pay out whatever interest is required for your state.
Okay, awesome. All right, next one. Do we need a bank account just for DoorLoop transactions? Some items on my bank aren't related to owner financials and don't need to be categorized in DoorLoop. And now the DoorLoop balance and bank balance are different.
Right. So, and this is probably the last question, David, because we have stuff at 1:30.
Yep.
So, you should not be commingling your funds. So, if it's a personal bank account, it should not be in DoorLoop. Only things linked to your business should be in DoorLoop. So, only your business bank account or the trust accounts for the owners that you service, their bank accounts, those are the only accounts that should be in DoorLoop. None of your personal credit cards or personal bank accounts or personal investment accounts should be linked to DoorLoop. And that applies to any bookkeeping software, DoorLoop, QuickBooks. You shouldn't commingle your personal funds with the business records, because these platforms are simply for businesses, not for personal financial reporting.
Okay, awesome. All right, that is all the time we have. There are still a lot of questions. So what I will tell everyone, if it is a very DoorLoop related specific question, please log in to DoorLoop and click on the blue chat button on the bottom right of your screen and ask us the question anytime. We'll get back to you right away. If it's more of a tax, planning, strategy, bookkeeping question for Raman, feel free to go to his website. I'm going to throw it in the chat one last time here. You can click the contact tab on his website and send him a message there. And if he has free time, he would be happy to take on more clients, obviously. And then lastly, if you are not a DoorLoop customer yet, feel free to just go to DoorLoop.com and schedule them. We'll be more than happy to help. And stay tuned for the next webinar coming in the next 30 days. We're going to continue this expert series. We had an attorney last month. We had a CPA now. So thank you again for joining us, Raman. You're getting a lot of love in the chat. So Raman, thank you so much again for all the time. I really appreciate it.
Sure. Have a good one.
Take care, everyone. Bye-bye.